Hello and welcome back. Today we are deep diving in one of the grand old men of the Indian equity market, Kirloskar Brothers Limited, or KBL. Established way back in 1888, this is not just any company. It is a legacy brand that has literally fueled India's industrialization journey. When we talk about engineering excellence, KBL is the name that pops up in every boardroom. They aren't just making pumps, they are building the lifeline for our sectors, from agriculture to space research. With over 135 years of history, this mid-cap stalwart has seen many market cycles and still stands tall. If you are looking for a company with deep roots and a forward-looking vision, KBL fits the bill perfectly. Let's decode if this stock is a value buy or just a legacy play for your portfolio. KBL is a proper made-in-India success story with a massive footprint. They operate in over 75 sectors. Talk about diversification, yar. Their bread and butter come from a wide variety of pumps, centrifugal, split case, and multi-stage. But don't think they are just for local farmers. They are providing critical systems for nuclear power plants, irrigation schemes, and even the Indian Navy. Whether it is a small submersible pump for a field in Punjab or a massive vertical turbine pump for a metro station in Delhi, KBL is everywhere. Their presence in the oil and gas and building services segments is also quite robust, making them a well-rounded industrial play that doesn't rely on just one sector to drive growth. Now, let's talk numbers, because at the end of the day, that's what matters to us investors. KBL has shown some very decent growth in its top line. In the last financial year, their consolidated revenue crossed the 4,000 crore mark, a solid achievement. More importantly, their EBITDA margins have seen a healthy uptick, showing that the management is focused on cost optimization and better product mix. Their PAT, or profit after tax, has also been on an upward trajectory. However, as an investor, you must keep an eye on their working capital cycle. Since they deal with large government projects, payments can sometimes take time to realize. But overall, the balance sheet looks quite clean, with manageable debt levels, which is a big thumbs up for conservative investors. What makes KBL stand out in the crowded pump bazaar? It's their moat. They have a massive R&D facility in Kirloskar Valley and over 12 manufacturing plants across India, the UK, the US, and South Africa. They aren't just importing tech, they are exporting it. They hold hundreds of patents and have one of Asia's largest hydraulic testing facilities. This tech-heavy approach allows them to manufacture pumps that can handle extremely harsh conditions, something local players simply cannot match. This technical edge gives them pricing power in high-end industrial projects. Plus, their huge installed base means a steady stream of high-margin aftermarket services and spare parts revenue. Once a Kirloskar pump is installed, the client is tied to them for years for maintenance. The future looks quite bright for KBL, thanks to the massive push by the government of India. Have you heard of the Jal Jeevan mission? It's a multi-lakh crore project aiming to provide piped water to every rural household. KBL is a primary beneficiary here. Then there's the Gati Shakti plan and the development of 100 smart cities. All these require massive water management systems. On top of that, the shift towards renewable energy is creating a demand for specialized pumps in the green hydrogen and solar space. The China Plus One strategy is also helping KBL, as global companies look for reliable Indian engineering partners for their supply chains. Exports are becoming a huge piece of the pie for them now. Every rose has its thorns, and KBL is no exception. The biggest headache for the company is the volatility in raw material prices. Steel, iron, and copper are their primary inputs. If global commodity prices shoot up, their margins can get squeezed quite badly. Secondly, the domestic pump market is very fragmented. You have many unorganized players in the agri segment who compete solely on price, putting pressure on KBL's low-end volumes. Also, a significant portion of their business comes from government tenders. Any delay in government spending or changes in policy can lead to a lumpy order book. We must also watch out for any family disputes or governance issues, though the current management seems quite focused on professionalizing the setup. As smart investors, we always look at who is running the show. The promoters hold a very healthy stake, around 66%, which shows they have skin in the game and are confident about the future. Institutional investors, both FIIs and DIIs, have been maintaining or slightly increasing their stakes over the last few quarters, which is a sign of institutional trust. The company has a long history of paying dividends, which is quite pace of asul for retail investors who love a steady income. The governance standards at KBL are generally considered to be top-notch, with a professional board guiding the strategic direction. They have been very transparent with their investor presentations lately, which is a great sign for the Aam Aadmi investor trying to understand the business. So, what is the final verdict on Kirloskar Brothers? It is a classic value play in the industrial space. With India's infrastructure story just getting started, KBL is perfectly positioned to ride the wave. If you have a long-term horizon of 3 to 5 years, this stock could provide steady compounding. It's not a get-rich-quick scheme, but a solid, blue-chip-like performer for your core portfolio. Keep an eye on the quarterly earnings and the order book growth. If they continue to improve their margins and expand their global footprint, the sky is the limit. Always remember to consult your financial advisor before putting in your hard-earned capital. Thank you for watching, and as we say in the markets, stay bullish and keep investing.